Hi, class, and welcome to Chapter 6. Chapter 6 is talking about efficient market theory. Who can actually beat the market? That's going to be our discussion within Chapter 6. And I think the key here is we're talking about hypotheticals and theories, things that some economists and some theorists have kind of thought through to make an educated guess as to a way to maybe make more money in the stock market or maybe not lose money in the stock market. So what actually is efficient market hypothesis? We call that EMH. First of all, the efficient market hypothesis is the idea that financial markets quickly and accurately reflect all available information, making it impossible for investors to consistently outperform the market by picking individual stocks or timing trades. So what they're saying is, hypothetically, no matter what you do, no matter what strategy you put together, the market constantly will change based on what's happening within the industry, within the world, political climates, and so forth. So it's not that easy to predict all of that. And that's what the hypothesis is positioning itself to prove. So according to this theory, stock prices adjust immediately whenever new information becomes available, meaning no one has an advantage in predicting future price movements. So with that said, how can someone say, I'm going to turn a profit for you? Trust me, I've got some great computers that actually generate algorithms, and through my AI, I'm going to make sure that you can beat the stock market. According to this hypothesis, it's not possible. So because of this, the hypothesis suggests that attempting to beat the actual stock market is pointless, since all relevant data is already included in stock prices. Now you say, what is relevant data? Well, what's happening in the climate, what's happening in the environment, what's happening politically, what's happening when people kind of boost up the price due to behavioral financing. All of these elements, all of the data is already included in the stock price, according to the hypothesis. So instead of trying to create the best strategy for most investors, is to actually invest in terms of the broader market index rather than searching for undervalued stocks or predicting trends. Undervalued stocks are stocks that people really don't believe are going to be valuable within the near future. Now, the average person who is trying to be their own individual investor will go look for those undervalued stocks, according to the hypothesis, and sit back and hope that it will produce the yield or the return that they would like. The efficient market hypothesis was developed in the 20th century by economist Eugene Fama, who introduced the actual idea way back in the 1960s. So it's been around forever. And the stock market itself has been around with a whole bunch of speculations, speculative investments. People wouldn't even think about how they're supposed to invest. So the hypothesis was presented. So he built on early research suggesting that stock prices follow a random pattern and cannot be consistently predicted. That's the origins. We're saying from the very beginning, from the inception of the stock market trades, no one could actually accurately predict whether they're going to go up or whether they're going to go down. But all of the data is there, and that is what's supposed to be included when you see the price of the stock. His work categorized market efficiency into three levels: weak, semi strong, and strong. Still part of the origins, weak efficiency suggests that past price movements do not predict or help to predict future prices. Furthermore, semi-strong efficiency argues that all publicly available information is already reflected in stock prices, and strongly efficient claims that even insider information is incorporated into prices. Now you're going to go back to think about inside trading. You know what's going to happen. The company is going to show their revenue in the next quarter, which is like amazing changes in their revenue. So that's going to raise the price of their stock. So you're thinking, wow, I'm going to make some money. According to the hypothesis, insider trading is already incorporated into the prices. Weak efficiency, weak efficiency suggests that past price movements do not help predict future prices. Semi-strong efficiency argues that all publicly available information is already reflected in stock prices, and strong, efficient claims that even insider information is incorporated into prices. Hit that slide twice so that you will get exactly the different dimensions that the hypothesis is claiming. So, this theory becomes highly influential in the study of financial markets, shaping academic research and investment strategies. So, part of the origin. So, now let's look at some examples of how the efficient market hypothesis appears in real world investing. Real world investing. One example is how stock prices react to earnings report. When you see, for example, let's say IBM and RCA, they're showing you how their earnings are turning out in first quarter, second quarter, third quarter, fourth quarter. So you're thinking that's a predictor that if their earnings keep going up, that stock's going to go up. You're going to hang on to your stock. So that's an example. If a company announces higher than expected profits, just spoke about that, its stock price typically rises immediately because the new information is quickly processed by who? The investors. They're going to be watching the stock market. Well, how do you watch the stock market? Do you just simply look at the ticker symbols? You jump on NASDAQ? No, you go onto the platforms from Yahoo Finance to Morningstar, which I spoke of earlier, and they're going to show you all the predictions, all of the numbers that are changing. And that's going to give you an idea of how the stock is going to perform. Another example is index fund investing. That is what I believe in. I believe in investing in indexes, mutual funds, so many different areas because I want a more diversified portfolio. And that's what this hypothesis is saying. If you're trying to beat the stock market by going with individual stocks and you're trying to map it yourself, it's not going to help because you know how portfolios work. First of all, the stock market itself is very fragile. It's volatile, which means it's going to be changing ever so much. So if you have your stock invested in one particular industry, one particular sector, and it goes down, then your money goes down. But if you have a diversification in your portfolio, your financial portfolio, this is one way that you might even the playing field slightly, according to the hypothesis. Since the hypothesis suggests that beating the market consistently is unlikely, many investors choose index funds, which I just mentioned, which passively track the overall market instead of trying to select individual stocks. The key word there also is passively, which means you aren't actively maintaining that particular portfolio. You're investing in it and hoping that it turns a profit for you through those index funds. A third example is the rapid response of markets to major news events. In a previous chapter, I talked about how Tesla, unfortunately, has got into politics. And the optics are, it's not a good look for him in terms of running his company and trying to influence some of the political decisions that the president of the United States is making. So here's an example of it. a rapid response to markets through major news events. Tesla stock is plummeting. He can't even unload some of the cars and vehicles for free because a lot of Americans, a lot of the world has turned their back on him because of some of the extreme measures that he tried to institute while he was in that unique position that the president put him in. And now he and the president are at odds. If a government announces a new economic policy, case in point, or a central bank changes interest rates, stock prices adjust almost instantly to reflect the new expectations, supporting the idea that market it processes information efficiently, meaning the market knows what's about to happen, and so it's going to adjust accordingly. Let's get into some of the strengths. One strength of the efficient market hypothesis is that it explains why most actively managed investment strategies fail to consistently outperform the market. Now, earlier you heard the word passive. Now we're talking about actively managed. Actively managed portfolios means there is a brokerage firm or a company of some sort that is actually investing for you. You know, there's so many that are Schwab, there are many firms out there, but of course they're not free. So when you think about using an actively managed, let's say, investment strategy, you're going to have a lot of fees. And so whatever your return is on your investment, it's going to be eaten up by some of the fees. So something to think about. That's part of the hypothesis. Research also has shown that professional investors rarely achieve long-term returns higher than simple index funds, supporting the idea that markets quickly adjust to new information. That's some of the strengths of the hypothesis. It's saying there are some really great things that the hypothesis is telling you to pay attention to. More of the strength is another strength we should say is that the hypothesis encourages passive investing. We talk about passive, we talk about active, which reduces cost and risk for the investors. So the hypothesis is saying if you are going to go with the index and with the firm, have them passively maintain your portfolio, which means let the money, let's say, passively grow without any major monitoring. By following the idea that the market cannot be beaten, people can focus on long term investment strategies rather than short term speculations. When I go to Viejas or Barona, which is our local gambling casinos, I am a speculator. I'm speculating. I am not even knowing what's going to happen when I put that dollar in and I pull that, let's say, one arm bandit. The slot machines. I have no idea of predicting, I have no idea. But if I do a hypothesis and say, well, one way or another, if I stay here long enough and put enough money in, something's going to happen. I'm doing maybe an educated guess or a speculative guess. That's what this hypothesis is talking about. You can't beat the market. So additionally, the efficient market hypothesis provides a logical explanation for why stock prices reflect all available information, making it a useful framework for understanding market behavior. That's a very important part is market behavior. And that's your behavior. Your behavior sometimes generates the behavior of the market. When you, let's say, get a little excited and you decide you're going to pull all your money out of some stock, what if everyone did that? The stock's going to plummet because of the fact that they don't have the stockholders in there anymore, and they're thinking, wow, so the world is seeing, for example, opposite for GameStop. GameStop, people dropped money into GameStop and was buying stock left and right. So that was kind of like a false inflation, which means there wasn't an inflation in terms of people loving to get their hands on the stock. It was basically, it's called when you inflate the actual stock. So same concept. One weakness of the efficient market hypothesis is that it assumes investors always act rationally. That's what it has to make that assumption. But in reality, emotions and biases often influence market behavior. I just spoke to that. Market bubbles and crashes occur when investors collectively make irrational decisions, contradicting the idea that prices always reflect true value. GameStop, look it up, Google it. Find out what happened with GameStop prices in terms of their stock prices when a few investors decided we're going to buy up everything and we're going to put a false assumption that GameStop's going through the roof. And that was just the opposite. Another weakness is that some investors have been able to outperform the market, suggesting that opportunities for above average returns actually do exist. Certain strategies, such as value investing, have shown periods of success, raising doubts about whether markets are always perfectly efficient. So, certain strategies do suggest that value investing have shown periods of success, rising doubt about whether or not markets are always perfectly efficient. Something to think about. Alternatives. Some of the alternatives to the hypothesis are there are several alternative theories that challenge the efficient market hypothesis. One alternative definitely is the behavioral finance. They're saying, look, okay, if we say this is going to really be the hypothesis to work with, you got to include one particular caveat to that, which is behavioral finance, which argues that psychological biases cause investors to act irrationally, leading to market inefficiency. Which means if everyone acted rationally and followed the numbers, followed the flow, and didn't really lose it, then the hypothesis would still have strengths. So, one of the alternatives to look at the hypothesis is that behavioral finance comes into play. This theory explains why stock prices sometimes become overvalued or undervalued due to herding behavior, fear, or simply greed. Another alternative is the adaptive market hypothesis, which suggests that markets evolve over time and can be efficient in some situations but inefficient in others. This theory combines ideas from the efficient market hypothesis and behavioral finance to create a more flexible understanding of market behavior. With that said, folks, that is the conclusion of my mini lecture for Chapter 6. Now, I encourage you to look at the rest of the PowerPoint and also to review the chapter and look at some of the videos. Ladies and gentlemen, we're getting into Chapter 7 next. Thank you for your attention.